Good evening, participants and partners. Thank you very much for taking time out to join us for another episode of Market Pe Charcha. I have with me, as usual, Dinshaw to discuss on the markets and what's happening. But before we get into it, let me just dwell upon yesterday. The AMFI numbers came in for last month, and let me share that equity as an asset class, had seen a higher net sales. In fact, SIPs continued to stay positive. And in fact, about 11 lakh SIP accounts has been added in last month. Then sure, in that, let me pick your mind on this, that last 2 months, we have seen growth in the mid cap net sales. Last month, there was mid cap net sales, and this month, the July month, and it was apparently small cap, which was highest in the net sales, about 7,000 odd crores, roughly 2,000 plus crores net addition in the small cap space. So we've been talking about it for some time, that but your take on this, that why, is it now the time go full on the mid and small cap, and what's your take on the overall market from here in terms of a valuation perspective? I know that nothing much has changed between last month and this month, but I think we have started seeing some earnings coming in. There was a policy, I think things have changed from what they were interpreting last month to this month. In fact, the policy was I mean, it was sounding dovish, in fact, with no marks on the inflation worries, right? However, guidance of a higher inflation towards the third quarter and so on. So world over, we are seeing inflation. In fact, last month, last week, in fact, US, in fact, intervened in yen, yen also in terms of currency, right, supporting them. So overall, what's your outlook on what's happening across and per se for India and Indian equity markets? So if you could start from there.
Okay, so too many questions in that one single thing. So let me break up a bit. Let me start off with the overseas and then I'll move on to India per se. So basically, the biggest overhang today is the upheaval going on in the Middle East. Our call is very clear. The day that Hormuz opens up, so it doesn't matter whether Iran is a problem or US is a problem or even Israel is a problem. The day that Hormuz opens up, crude will come back down sharply, and that still holds. One saw that the last time it opened. Crude, in fact, fell off quite sharply to below Brent, or rather was below $70, and the WTI was below $65. Now, the fact is that it's in the interest of US to let the oil prices be a bit more firm, because their cost of production is for the new wells is $72. So that is why I think some upheaval is going on. But my feel is it can't last too long. US is suffering. Inflation is high. The new housing starts in the US have gone down quite a bit. Means purchasing power is going down for the consumers. And that's a worrisome point for Trump. Don't forget, November is when the midterms are coming. And probably he wants to get things right before that. And that's why he's now trying to give some sweeteners in terms of taking away capital gains on securities and all that. So he's trying all that stunts, but ultimately it'll be obviously inflation, which will be driving sentiments out there already above 2%, which is beyond the Fed's comfort area. Though they did this time around, I mean, when you're talking about the dovish stance, it was more of the Indian regulator than the US regulator. The US regulator was a lot of pressure to increase rates, but he refrained from doing it.
Yes.
And that I think will play out later in the year. Obviously, Trump is desperately trying to get that in the Fed chair in line, the new chair. But the new chair can't go beyond his mandate per se. So that's a lot of things happening, moving parts there. My feel is the Gulf problem will come off pretty easily. By the way, the one which you talked about the about US and Japan jointly intervening in the yen. because yen had shot up to 165, which was unpalatable to the US. They want
Yeah,
their currency to be weaker, and that is why they intervened as such and let the yen come back to a more stable place of 150 to rather 157 today. But they want it between 150 160 and not beyond that, because that's where when the real problems start if it goes stronger than this. So that way. So on the global side, the concerns are more on AI expenditure. Uh, I think that is where the real concern is, not on the usage of AI or the efficiency of AI or the use case for AI. That is
correct.
established, and it's only the capex where the problem is. And I think that will be sorted out in due course of time. So outside world doesn't look to be too dicey, except that one particular AI portion, which we believe is ripe for a valuation correction. It's not a bubble. Please don't take us wrong. It's a valuation correction which may come about, and that will be a gradual one. Ultimately, two more IPOs are yet to hit. One is obviously Anthropic, the other one is OpenAI. As and when that is through, you may see some correction creeping in, but that should be good news for India because a lot of money is stuck in AI trades. I think that will be released, and India should see some flows coming back in. Coming back to India, uh, our problem was that growth had disappeared, as I earlier also said. Growth came back. Growth came back from September of last year, continued into December quarter and the March quarter too. I've already shared those numbers, so I won't even harp on that. The June quarter, growth again remained quite firm. In fact, everybody had written off the June quarter thinking that it will be probably, and so it had we, because we also believe that all the high cost inventory is going to hit the results of the June quarter. Obviously, the corporates, if they pass on that high cost inventory burden to the consumer, will see a reduction in demand. But fortunately, it didn't happen. And in fact, June was a fairly decent quarter. It wasn't as exciting as the March quarter, but came out pretty good. The large caps, however, again were a laggard. Same as was in the case of March and the December and the September quarter. The large cap growth rate, even X of oil, is not that exciting. Uh, the mid caps is better than large caps, and obviously the small caps is far higher. I'm still awaiting the final number, so I will not comment on the percentage growth, but it's been fairly healthy if I see the advanced numbers that came through as such. So, in that basis, we continue to believe that mid and small is the place to be in. And obviously, the reasons are fairly clear in the sense that the large cap cohort is not seeing too much of growth, mainly because of the fact that it's heavy on IT companies where the growth is like at best low single digits. They're heavy on FMCG, where at best again the growth is high single digits, or for that matter, banking, which is right now suffering. And the growth rate again there is mid single digits to high single digits. Commodities, some make loss, some make profit, but the point is some game is zero. So obviously this is where the problem is with the large caps, and that's why the growth is very low. In the case of small caps, however, they're full of vibrant sector. They're full of new age companies. You may find one or two in the large cap space, but the mid and small are full of the new age companies. They're full of auto ancillaries, which are doing very well as such. In fact, as I keep saying, that they're precision engineering companies. They're classified as auto ancillaries because the bulk of the supply goes to autos, but they're precision engineering, which is used in all other industries, defense, aviation, so on and so forth. And I think that is where India has made its mark in aviation, at least. So I have no doubt that these will become sourcing basis for even for international aviation companies. Uh, there's a lot of NBFCs playing out in the mid cap space and small cap space. A lot of market facing players in the mid and small cap space. A lot of durable players, consumer durable players. A lot of hospitality companies, hospitals, and so on and so forth. I think so. That's why that vibrancy in the numbers in that space rather than in the large cap space. And that's why we continue to be bullish here. We've been very proactively shifting our weights to mid and small caps. You've seen that in our flexi cap. You've seen that in our mid and small cap that we constantly continue to be there. In fact, we were so gung ho that we launched a of emerging star PMS
Yeah.
first, which was in March of this year, and then later once the approval came through, we launched even an AIF, an emerging star AIF, which is going to be a pure 50-50 mid and small cap play as such. And
So I'll take it forward. So, in fact, in the last month, large caps have also seen net negative flows, in the market, in fact, as per the AMFI data. So I think, clearly it indicates also that investor interest and partner interest, is largely moving towards mid and small cap. In fact, even Flexi has, come off a bit in the broader net numbers, right, compared to what it was in March. So clearly, mid and small cap taking off, which we can see also through the number. So, just, picking up on the policy, because I think it will play a key role as we progress, in terms of growth, because, we're seeing the growth coming in. In fact, the guidance is that, I think we can hit 7%, right, kind of a growth number also. But what happens, where do you see the interest rate hikes, kind of coming in, if at all? It's like, sort of uh, visible that there could be a possibility of a, rate hike, right? If US raises, I think, we'll also have to follow it through. But then, how does it impact the overall growth, the momentum which is built up in the, Indian equities, right now, in terms of valuations, we look much better right now in terms of growth versus valuations and what's happening outside. So what's your take on that, that point, that if just in case, let's say, for example, towards the last quarter or towards the first quarter of next financial year, right? Not this financial year, next financial year, let's say there is a interest rate hike. How would that impact the mid and small cap? Will that at all impact the mid and small cap, first of all? Because that's something which we keep, now, uh, as a question, keep getting from our distribution partners also. So your take on that?
So, okay, on the interest rate funds we were initially of the opinion that probably by the end of this fiscal, there may be some hikes coming, right?
Yeah.
Uh, Either end of this calendar year, which is December meet, or probably in the next in the March quarter. I think it's not going to happen. If you look at the inflation data, and if you normalize the curve, the data points within the inflation, that is, if you normalize that, it looks as if we are in a very safe place. The only reason if we have to increase inflation, I mean, interest rates, won't be inflation. Obviously, it won't be inflation. It'll be more of, I think, international pressures in terms of
Yeah.
if US increases rates quite sharply, which I doubt,
Yeah.
because for that to happen, you will have to increase rates by, say, 50 basis points within this particular calendar year itself, which I don't think is going to happen. I think the Walsh is under a lot of pressure from the presidency to hold back rates hike. So that won't happen. Only if that happens, you'll see some hikes happening out here. Otherwise, it won't. By the way, interest rates normally are associated with the fact that the costs move up for your interest outflows, and as a result, the earnings suffer to that extent. But it's not only that case. Normally, the interest rate hikes are also associated with the PEs of a country, because your DCFs then start getting compressed. Because ultimately, when you apply a risk-free rate to your DCF to calculate the present value, the higher the interest rate, the higher the risk-free rate, and as a result, your present value of the DCF shrinks. So that is one direct impact which comes through because of increased interest rates. The second impact is obviously, and that is why the valuations compress, by the way. Normally, the thumb rule is 1 divided by interest rate should be the PE of a country, right? So as you increase your interest rates, the PEs move down. Yeah. So that's another impact. Otherwise, I don't see much happening out here. I don't think there's an interest rate hike happening. Fortunately, this fiscal, I will rule it out totally. Probably going to the next fiscal, depending on how the monsoons pan out. If the monsoons are not that great, you may see inflationary pressure kicking in next year, but not this year. So that's why I'd rather wait it out than take a call on this one. I don't see much impact happening on the mid and small caps because of this as such.
In
And
anyways,
frankly,
yeah,
even if you look at the balance sheets of mid and small caps, today the small cap balance sheets are much more stronger than even the large cap balance sheets. They're quite cash heavy. There's less of borrowing. In fact, the debt equity last I checked was 1.27 as such, while the large cap was close to north of 0.5 per se. And mid caps also were 0.54 or 0.55 or something. So that way the balance sheets are strong. They won't be impacted because of the hike in interest rates. And secondly, you talked about valuations. Valuations again, still known. Obviously, they don't make sense. Why they don't make sense is because you won't know what the growth is. So if I give you two stocks, one with a P of 20 and one with a P of 15, obviously your first uh, thing will be that 15 looks cheaper than 20. But if you're a smart investor, you will ask me the next question is what are the growth rates? And if I tell
yeah.
you that 20 P is going to quote at is growing at 20%, while the 15 P is growth is 5%, you'll definitely jump for the 20 PE after that because in your mind now you start calculating the PEG, the price earnings to growth. And for a 20% growth for a 20 PE is PEG is 1, while for 15 PE for the 5% growth PEG is 3. Now the 20 becomes cheaper than the 15 PE stock. So that's why you'll go for that. Same is the case with the large, mid, and small. On a PE basis, the large caps look the most cheapest at 16 and a half times forward earnings. And the mid caps are the most expensive at probably 25 times for forward earnings, slightly higher than that or whatever. And the small caps are in the mid range of 21 odd forward earnings. But then the growth rate in the large caps is around 11, 12 times, 11, 12%. So basically the PEG is 1.5, 1.6, while in the case of a small cap, it is, small and mid cap both, the earnings growth are 23%. So the PEG for the mid cap works out to 1.1, while for the small cap, it's around zero point 0.9 or so. Now the small cap is the cheapest, close to it the mid cap, and the large caps are the most expensive on a PEG basis. So that's why I would rather be very careful in looking at pure play PEs rather than PEG. So even on that basis, the mid and small caps look far better than the large caps.
In fact, anyways, the policy rate, I mean, inflation, the target of 4 plus or minus 2%, I think, largely it would, you're right, that the chances are very. So I would request participants also to type in their questions, in the Q&A box, and I shall take that up in a couple of minutes' time. So Dinshaw, another thing that, so now you can see credit growth coming in, in fact, auto sales numbers were also encouraging. Monsoon numbers have also reversed in the recent reports run by brokerages, right? So my first, taking up the portfolio question. So where will more tilt in allocation would be between banks, NBFCs, and the capital market, and then, where would, we would tilt our allocation going forward?
So banks, I think, have done their bit. Frankly, I mean, the banks used to earn a lot because of the free float they used to get by way of CASA and stuff like that, right? That has vanished for these guys. So the NIMs will constantly be under pressure. And that's why you'll notice that we've been consciously reducing our exposure to banks. Though as a BFSI, as a sector BFSI, the exposure hasn't gone down. And that's because we've been constantly hiking our exposure to NBFCs and to market facing players as such, the capital market facing players. We're actively changing the mix to that because, frankly, I mean, if the economy has to do well, the sector has to do well, BFSI has to do well. But as I said, banking has a lot of confidence, a lot of competition built in. Plus, if you look at the historic banks, they've always been dependent on NIM, on CASAs, which are now vanishing. So that won't play out for them going forward. And I think the biggest beneficiaries will be the new age NBFCs, fintechs as we know them. They'll be do far better than banks as such. So that's why we are increasing our focus right now.
So I'll take, the first question. Sure, there is, the question is that there is a lot of buzz from most of the AMCs that large caps will bounce back. once the FII buying comes up. Since July, also the mid caps and small caps have performed better. Yes, on first data also suggests that. So, what are the reasons for large caps to start performing better, and by when can this be expected? So, I think in our opinion, also, I think we've been. In fact, I will club with another question which has been written that we have a lot of new age, and we also been internally debating this, Dinshaw, that the companies or the businesses which delivered in past couple of decades may sort of not have that kind of a growth which is which is very encouraging for the next decade and a half. So your view on this?
So basically, on the large cap front, as pointed out earlier, also that the problem is the cohort of large caps. But fortunately, India, we do change the large cap cohort also, in the sense that some of the mid caps convert to large caps. And that happens on a very gradual basis. Every 6 months, this rotation happens. It'll take like 4 or 5 quarters even before you see some semblance of growth coming back in the large cap bucket. And that's why I'm not a buyer of the fact that large caps will very shortly now start outperforming the mid and small caps. Maybe there may be some hope trade happening, which may see the large caps moving up a bit. But we are very clear that the mid and small caps will continue to command growth, and money chases growth. And we've shown that earlier also. If you've seen our last presentation, we made it very clear that even in the top 10 holdings that the FPI held, they were conscious sellers. And all these top 10 holdings, by the way, this top 10 holdings I'm talking about was March 22. And they were conscious sellers across those top 10 holdings. And they, in fact, moved over that money to mostly mid and small caps because they were active buyers. In terms of flows, there are two separate flows. One is passive flows, which tracks the index, and one is active flows, which tracks which chases growth. Obviously, the active money which you see today flowing in is more of active money than passive money which is coming in. Our feel is this money will continue, given the fact that India for the first time outperformed after a very long time. And when I say long time, I'm talking about probably around 1.5 years that India started showing not even 1 year and 9 months that India started showing growth in terms of better growth than the region, than the emerging markets, than the world markets in June. And that growth continued into July. August also seems to be a very healthy month for India. And that's why you've seen the selling abating from FPIs and some amount of buying having being creeping in now. My feel is this buying is more of active funds which are coming in because the passives have increased the weight of India, but not that much. They still are underweight, almost 200 basis points across portfolios. So that is what I'm looking at. And I think given that fact, I think this is that's why we are so keen on mid and small, and we don't think the large cap cohort will do well for the next at least 4 or 5 quarters as such.
So there is a question on view on banking that we covered. Our outlook, Dinshaw, on IT sector. So apparently the sound bites you are also seeing now. Majority of analysts and those who track IT and even managers been talking about that IT as a sector at a later stage would get into the implementation, right? So once the manufacturing bit of AI is done, IT would play a significant role, and especially Indian ITs would play a significant role in the implementation of that. So your take on that, Dinshaw?
Yeah, I've been also hearing those stories, but they are stories and nothing else. So let's start off with what our feel is on IT. By the way, I don't know how many of you have heard the sound bites which have come out from all these IT companies. I mean, they talk about AI related projects that they've been getting, but some of them have been very clear in calling out that these projects are very short term in nature. They get executed within 2, 3 months or max 4 months, and then they're out of that company. So basically, it's purely implementation of enterprise level AI which is being played out. Unlike cloud conversion, where the conversion used to happen and then for some maintenance used to be there, the services provider used to be there. That's not the case in AI. Every enterprise wants an AI solution, uh, and this solution is mainly some LLM, which is available. By the way, there are 30 LLMs available in the market today. You implement those LLMs on your enterprise level servers, and then you move out, make sure the guardrails is in place, and you move out. That's what happens out here. So that the longer term, they'll get more business because of AI. I don't think that's going to hold. One more thing, maybe, I mean, even if you assume that we are wrong on AI, why, I mean, as an AI being a disruptor, why do you think the growth rates have vanished for these IT services guys? Obviously there's a reason behind that. It's not that US is suffering. US is growing phenomenally well. They should make more spend on IT, right? They're not happening because the AI guys have taken away a big chunk of their business, and that's why they're not happening. One more thing that we keep saying, and let me repeat it at the cost of saying it again. The fact is that when there are disproportionate gains in market shares, it happens at the cost of someone losing market share, right? Uh, if you're growing your market cap with the growth of your earnings, then obviously it's understood that it's because of the earnings that you're growing market share. But when you're growing it disproportionately higher, then you're taking away from some other player. For instance, when a Microsoft started gaining market share, it was at the behest of killing a IBM or a Dell, and their mainframes were shattered, and that's why Microsoft gained that market share because of its desktops. When Apple came into play, what did he do? He destroyed the likes of an Ericsson, of a Nokia, and stuff like that, or BlackBerry for that matter, and he gained market share from these guys, and that's how he made his market cap. When a Eternal or a homegrown Eternal came into play, whom did he disrupt? He disrupted the Kirana fellows. He disrupted Avenue Supermart and stuff like that, and he made his market share gains from that as such. Yeah. Same is happening out here. The AI players are disrupting no other than the services guys as such. And that's why they're getting the market shares. I mean, Anthropic is looking at a market cap of close to $900 billion. OpenAI is looking at a market cap of close to $800 billion, $7 to $800 billion. These don't just come out of thin air. They've disrupted somebody, and that's why they're coming out. And unfortunately, the disruption is the IT services guys, not only India, across the globe. Most of these guys are cutting their guidances on a regular basis. They give out guidances. That's why they're cutting guidances as such. So I have no, probably after 3 years, this may come by. But in the immediate short term, I don't think there's any growth left for the IT services guys. Maybe the small cap or the mid cap guys may do it, which is good for us because we're looking at small cap mid only right now. And that also may happen because, as I said, that most of these projects, the AI projects, are short term in nature. For them to pick up a small cap company to pick up a $20-30 million project is not a problem because that adds a lot of growth to their revenues as such. And that is why you'll see that these mid and small cap IT services guys are doing far better than the large cap guys. For them, it won't move the ticker. Even a 100 million like kind of a contract doesn't move a ticker. Unfortunately, you don't get 100 million contracts for AI. You just get 20, 30, $10 million kind of contracts. And that's what is happening in that field as such. So
The question had an added part that whether we should shift money to mid cap. My suggestion would be that it's completely based on the investors, risk appetite. But our view, in our opinion, mid cap looks attractive, right? Of course, we've been, we Feb 25 onwards, we've been giving call and those funds have done well, right? So, so yes, as allocation, of course, mid caps do make sense. So you can. So there are more questions. Dinshaw, would you like to answer the question in terms of effect of cash on MFs in the first week of implementation? Would you like to answer that?
there's no impact actually. I mean, the point was that most of the institutions are not participating, were not participating in the cash, and that's why it was creating such a upheaval initially. Yes, there was an impact because in the sense my closing prices were always way different from my from the final closing prices were very different from what the 315 prices showed me, right? But The point is, the next day they used to reverse. So it didn't have an impact. It was just an overnight carry where the problem was. But I think now the things have become much more saner. The difference is not that much as compared to what it was in the initial days. And I think as the system matures, obviously the prices also will be much more. But globally, this is the format which is followed. It's not last half an hour VWAP which was followed earlier for our markets. Globally, this is the format which is followed. The bulk of the trades which are decided at a given price is the closing price, because you know that, and unfortunately, as I said, that since institutional participation wasn't there, the liquidity was very low, and as a result, the bulk of the trades used to happen at even 1,000 shares being bought at a certain higher price used to be the closing price. But if you have big sellers and big buyers, that won't be possible anymore. So that way, so I think give it some time; it'll mature. But as of now, it's not creating too much of an issue.
Then sure, moving forward, so there is one question, and this also is there on the social media very, very frequently, which is on MTF, right? We also hold, one of the companies, and we have enough data of that company. What's your take on this? Because people apparently are making statements that MTF holdings are rising, and that's a systemic risk. In fact, recently there was a comment from a large brokerage house also on that. So your take on that, Dinshaw, would you like to answer this question?
Can you elaborate what is MTF, by the way?
The margin trading facility,
Oh, okay,
the
okay. That one
brokerages,
was
I
understood.
think,
Yeah. I got
what
that.
I
I got
was
that.
seeing, the residual on one of the brokers, larger brokers account was very minuscule. It's been couple of thousand crores, the book size,
Yeah.
but still, yeah.
No, so now that's I think that would have been a panic situation had the speculative positions been so huge as such. I think most of the brokers were fairly conservative in using the MTF tool for only large caps. They weren't using that for your mid and small. So I think that is where the comfort has come in. One saw that. I mean, it started from 1st of April onwards, and still nothing has transpired to that extent. Sorry, was it 1st of April or 1st of June? 1st of
First
July,
of
sorry, it started 1st of
July.
July. 1st of July started. And nothing has transpired after that. So there's no major blow ups or anything of the sort. Yes, the margins, the volumes did go down in the FNO segment. The biggest, I think, loser of FNO volumes was BSE. And you would have noticed that in our latest portfolio, the absence of BSE in some of our funds as such. And that was a trigger for us. We realized that there's uh, something which is happening out here which you want to avoid as such. So that way. But I don't see a big blow up or anything of that sort happening out here because of this.
There's one more thing, Dinshaw, which everyone keeps expecting on the street, and they've been expecting and praying for it though for some time. But of course, we have to see how whether that plays out or not. But everyone has been expecting, and of course, there have been calls given out in early 2025 and all that mid caps and small caps will collapse, right? So people are always scared. But your take on that, how these companies have improved, or or the market cap wise they have grown, and what are the logistical advantages they benefit, the funding advantages they benefit, right? Compared to the first decade of the century, right? The way companies were, when we have seen crisis coming in, they becoming the most volatile, and we have seen sharp corrections there. How have that, in your opinion, changed now? I mean, where do you see those things right now?
So post COVID, actually, things have changed quite a bit. Pre COVID, all these guys were fairly leveraged. They were highly leveraged, if you will. If I remember my numbers right, I think most of the small caps, I mean, the cohort of 250 stocks, the debt equity was in north of 1.4, 1.5 times. Obviously, that was a concern area. And when COVID hit, it's not that they became smart and they cut off their fundings. Uh, the ones which blew up moved out of the 250 segment altogether. The stronger ones remained back. The stronger micro caps came into the mid cap fold. Small cap fold. Same happened in the mid cap as such. Quite a few mid caps blew up or became micro caps as such after COVID. So that's why the debt equity started becoming stronger. So as a, in fact, by the way, the government of India also has realized that for the country to grow, the SMIDs are the ones which they need to focus on, because globally, I mean, even the US, the SMIDs drive 65% of the GDP. So in India, it shouldn't be too different, though we don't have data, such transparent data. But I'm sure that is how the case is out here also. So I'm talking small and micro caps, by the way. And so in India also, they had to do something. And that's why they came down with these rules that you cannot take away the, I mean, you cannot, the working capital for SMIDs, you cannot hold it back for more than X many days. If it is, any SMID can go and complain to the ombudsman about this and so on and so forth. So they've also become very proactive towards this. And that's why I believe that now getting funding for a strong SMID, it's not going to be a problem at all. Even the banks are more than keen to lend because they have priority sector lending commitments, which are yet to be met. So that's why they're more than open to lending out to SMIDs as such. So I don't see that playing out anymore in that parlance.
Also these, the number of family offices going up, promoters, in fact, backing the new gen and new gen ideas, which largely we have seen in terms of, the rise of startups happening in India. Then show your take, which are the emerging themes, or do you also agree that in the years or, years to come, you will see rise of more startups in India. I mean, more and more startups. Of course, in last 10 years, we have seen many startups coming and in fact, beautifully, creating wealth for the investors also. But do you see rise of that even further from here you know,
So, okay, the thing is that India did something very different from the world in terms of the way they garnered, I mean, they rather went about implementing the Aadhaar system, right? Uh, Started off in sometime in 2008, and by now it covers most of the population. Almost 145 crore Aadhaars have been issued, right? So basically, it covers the whole population. Why that is important is because now we've got one single point of authentication. Earlier, some used to use a PAN, some used to use your passport and stuff like that, or driving license. Now you're on one single point of confirmation. You can open a bank account, you can get a passport, you can buy a car, you can get your health insurance, everything using that one single Aadhaar. That system is not available anywhere in the world. Okay, even in the US, the Social Security does not allow you to go and buy uh, a house or something. You can do your insurances and stuff like that, but not that, or a car, that for that matter. Yeah. So that was one. The other one was the Jandhan, which started off in 14 in earnest, total earnest, uh, giving bank access to all and every single eligible Indian. Very big news out there, because now you can do banking across India per se. And the last one, by the way, so UPI is an India born thing, right? And that came about because of this maturity of Aadhaar and Jandhan. UPI wouldn't have been possible without that. But the biggest mover of the ticket was probably the cheap data that India offers to its consumers. Cheap data in the sense the mobile data. I think if that hadn't been around, doing the implementation of Aadhaar and getting Jandhan in place would have helped, or getting even UPI in place would have helped. So basically, this trinity of jam, as we call it, Jandhan, Aadhaar, and mobile data, I think that has played out to the hilt for our country. Any company which is utilizing this trinity is up for grabs for us. I think this is where the real growth is for our country. And you've seen a lot of cohorts of companies coming out here, fintechs, food techs, e-com techs, D2C companies, a lot of insurance techs, pharma tech companies and stuff like that coming out here. I think this is where the real excitement is. And this is the emerging trend that one needs to capture. And nothing could have been more better than the fact that the actual consumers today will be the likes of a Gen Z and a Gen Alpha, which have grown up with this technology. We have to learn it, but these guys are born with a mobile in their hands as such, and that's why they know how to use it to the hilt. And frankly, I mean, I have a few Gen Z analysts in our office, and the kind of things they tell me about how to get a deal done and stuff like that is fantastic. I mean, I always learn from them on the tech front as such. So I think that is where you need to be in this segment, and that's why you'll find that we are very heavy on our all the new age companies that come by. We're very selective though, but wherever we see a lot of sense, we don't worry about valuations because we know the exponential growth rate will take care of those exponential valuations in the future. So that way.
So there was question on SIP and FlexiCap. Of course, it makes sense, from a long-term perspective. In true to label FlexiCaps, it definitely makes sense to do SIPs in that. But long-term can be based on risk appetite of investors, being done in mid-caps also. Second, there is a question on new age company. Yes, we are thinking on those lines, but on the AIF front, because not on the mutual fund side. But if at all we do, we will reach out to you. And I think there are no more questions, partners. So I would only request you that you can listen to more content on our channel of Helios Mutual Fund, and please subscribe to that and share with your investors. Also, we keep uploading content there, and this podcast will also go there. This will also go there. Market Pe Charcha, will also go there. Every month we upload it there. And if you have missed out anything at the beginning of this session where we covered a view on large caps and all that, because I see those questions there, you can take a listen into that at our YouTube channel. So thank you very much. Keep encouraging us to do this more and more, and we see you around next month. Dinshaw, before we close the call, your final take on questions on STP versus SIP. So what should they do?
So STP, I don't think that works. Actually, STP in a longer period of time, you're just trying to save a small blip for your client as such. And there's no guarantee also that the client will stick to his commitment to the STP. If the market moves up very sharply after his first tranche, he may just tell you to hold on because the market has moved up too much. Or if the market falls too much, also he may just react by saying that, look, I've already lost money in my first tranche. I don't want to commit more. So let's wait for the market to recover. So I think that doesn't work at all. SIP is always a good option, but STP, it's just a face saver for you to say that I try to conserve money for you, but otherwise it doesn't work. In a longer period, it doesn't help at all.
So I think there are a couple of questions related to some of the management's participants. We refrain answering those questions in this call. So apologies for that we have not answered those. So thank you very much for your time and patience, and we look forward around next month, same time. Till then, take care and subscribe to our channel. And if you have missed out on any part of this meet, please take a listen into that on our channel of Helios Mutual Fund. Thank you very much and have a nice evening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.